Welcome to TradeTheMBI.com. This is John's Reports for the 23rd, and not an unsurprising day the other day. We had a little bit of weakness that had been expressed by the rising short here from the DOC. We also have very weak shakeout readings. So we've been in this little consolidation. Again, we talked about the positive extreme that took place. Well, it was this bar right here, looking for those lows to be recaptured, which was right there at the 26.88 range. We went a little bit below it, just a tiny fraction, down to 82, and then started right back up on it. So that became the filling of it, and produced some decent ranges on the day. It was quite nice. Are we still seeing shorts rising? Yeah, but we also saw short-term buyers turn around, which is important given that we're not seeing any new activity from long-term or mid-term buyers, and not surprising given where we are in the month. So that wasn't anything to, but the gloom and doomers are still, last couple of years, it's too far. And yet, they got all excited on the whole memo dip that has been completely bought back. So not a whole lot of anything. Again, NASDAQ was looking a little weaker, still negative shakeout. Something to bear in mind, it just means you're going to have back and forth movement. Euro exactly where we thought it would be, having reset its shakeout at this particular point. Still in a DOC spread for the weakness of it, but holding up. So it's just an indication that people aren't really willing to jump on board because of the unknown of the U.S. deficit demand and the effective revenue on the Treasury for the U.S. It does have an impact. You're going to be drawing a lot of money out of what is otherwise available for business. But the strong employment and everything else as far as economic growth wise, your bias still has to be more to the upside, even though a lot of it's been priced in. There's that future potential of discounting, and this is something I talked about, almost 8 or 9 months ago. The expectation the market had that they were increasing the value of the market based on the devaluing of the dollar based off of inflationary expectations, and it played out exactly as the market predicted many months ago, and those of us who could see it knew what was about to happen. And likewise, that's why we still have that 113 target on the TLT for treasuries as rates continue to they have to move higher. The question is how delayed it will be, and the longer the delay, the better it is for growth aspects. And again, this is where the demand for the infrastructure move and everything has been sort of put off because you really don't need to add to the bottleneck and constriction. So it's not something that you really may even need until the end of the year, if they can even get it through. That's a whole separate issue. Oil turning back up. So again, this is part of that inflationary setup that we saw building from way back middle of the last part of the end of last year, growing all the way through to this peak, and then we had a little bit of softening during the weak market time. But that's still, it's going to be factored into the fact that you're having increased demand, and so even if you're able to meet that supply, the demand's still there, and then of course there's always the refining issues of it. But it gives us a global viewpoint. Likewise with gold, still remaining near its highs. It's going to have another run back up. It's filled in those positive extremes. Just to wait for the actual signal of that. That's not done on that climb. It's also been fun to watch the cryptocurrencies, which everyone has been enamored with. Even from our short up at the near 17,000 range viewpoint, we've been seeing that now that it's moved into a future category, it's become far more consistent, even more so than some of the other ones. At least Bitcoin has, and we can see that we've been in these consistent drawdowns with no resets of the steel in the recent time, even with some of these little short moves where you get the steel popping above the 13.5. It's like it's coming from underneath, gives it enough of that little push that moves it back up to key areas. But then we end up with our dramatic spike DOC spreads that give pretty good short readings here. We dipped as low as 95 right here at the 23% now. But from a 5K standpoint, pretty strong day. We ended up with some decent buys that came in off of the decreases bought everything back, traded sideways for a little bit, and then we got up to a nice peak move that was significantly higher, and it just filled it all back in. And of course, we had positive extreme all the way right to here. So that was calling for a return right back to this level, and guess exactly where we hit. Well, what's the low of that bar? We can go ahead and calculate 26.98, and so we know that we dipped a little bit lower than that to 96. You can only get so close, right? I mean, there's always that follow through, but knowing where the likely retrace values were going to be is always helpful. It just makes for the ability to withstand if you're going to go for a little bit bigger short, knowing that you're likely to get these pushbacks to the 50%, and then knowing which ones are going to support themselves over time. And when you don't see that reset, finally came down here, that was a little too early with the buys. They weren't in conjunction from midterm and the longer term setup, even from a 5K standpoint, which is always funny when you talk about long-term buy from a 5K. That's sort of like getting a weak signal on a 50K. There's not even an impact on the daily. We can see here in pre-market, though, the shakeout finally got back up to 0 points, and even if you didn't like this first one popping above the 23%, which it stayed pretty consistent, but it's nice because you can look at that and you can say, okay, I got 2704, and I've got, you know, a break of the low, 26.95 as a good stop. It gives you your parameters for exposure. You know, so in that case, you're looking at, you know, an 8-point stop. That means you're looking for, you know, at least that kind of a return to the upside, and more than eclipsed that by jumping all the way up into the 18 category. So that's how you can effectively play and estimate based on your exposure, because really that's what it's always about. It's about what you're willing to give as a stop dictates how much you need to return from a gain. Now, it doesn't mean that the market's going to give you that all the time, because if the signal changes, there's nothing you can do about it. But still, it lets you know that if you're going to risk that amount, you've always got to be prepared to take that profit factor based on what you're willing to allow for stops. And that's something that a lot of people don't take into account, because they'll see a little red, oh, I'm in the green, I'm going to take a little. You can't do that. You have to follow it based on what you were willing to expose yourself risk-wise, because at some point, if you do lose those, enough of them, you haven't made enough from a return. Now, we know that markets do trend at times, and sometimes they get choppy, and we know that we're in a little bit more of a choppy period, but despite that, we've still had some pretty strong lens. And in a weaker volatility period, maybe you would get 4 or 5 point moves. But now we're seeing, you know, 15, 20 point moves. So you take what you get as it comes, and we keep evaluating day by day. In this particular case, we've got a bunch of positive extremes off this move, and they're already starting to fill back. I would expect we're going to see more of that probably as the pre-market goes on before the open. But I would still be looking for us to get back up to these highs on a new buy signal during the day. So we'll keep an eye out for that. As always, though, anything relevant I will put up and point out. Trade well.